Hello, everyone. We're back. So excited to be here, and we're doing something a little bit different today. We are doing our webinar on a Saturday and trying to see if we have more people that decide to join us. But again, I am Melissa George, and this is Sarah Martinez Hanson, and we are Invest Her Fiduciary Solutions. And I'm super excited about our topic today. Sarah has spearheaded a whole program called Military Money. And I have worked with veterans over the years. My father was also a veteran. And so what we want to do today is we want to kind of break down the TSP, the retirement plan, the Thrift Savings Plan that is available to not just military people, veterans, but also the VA hospital. There's a lot of people in government that are have access to the TSP. So we want to break that down today. So, but just to give you a little bit of background, Invest Her Fiduciary Solutions will be 20 years old this September. So we're super excited about that. And Sarah has been with us for a little over 2 years now. So, just to tell you how amazing Sarah is, she is a career, I don't know what the term is when you transition from one career to another one.
Career changer.
Something simple. She's a career changer. She came to us a little over 2 years ago as an intern. Started her master's program in financial planning. She finished that in December. Now she is a full-fledged financial planner. So I'm super, super proud of her and happy that she's here. And I'm going to turn this over to her because she is going to be giving us some really great information today.
Thank you, Melissa.
You're welcome.
Okay, so yes, today we are talking about the Thrift Savings Plan, the TSP, and then also comparing it to other investment options that every military woman or person should know. So I'm really excited about this topic because it's a big deal. It's very important to get this right. So. Okay, so the agenda, we're going to be going over what is the TSP and understanding how it works, the funds within the TSP that are available, TSP versus other investment accounts like the IRA, Roth, or brokerage, the BRS advantage, which stands for Blended Retirement System Advantage, building your strategy, action steps that you can take, and then, of course, closing with Q&A and next steps. Okay, Melissa already did a great job at introducing me, but I'm just going to go a little bit further. And yes, I've been with the Invest Her Fiduciary Solutions for a little over 2 years. I am a female veteran. I was in the United States Air Force for 11 years. I'm also a surviving spouse. My specialized focus is veteran financial strategies and benefit optimization. And my personal mission is helping veterans transform their benefits into lasting wealth. My credentials so far: life and health insurance license. I have my SIE, and I just graduated in December of 2025. And now I have my master's of financial planning from the University of Georgia. I'm also currently working on getting my certification for accredited financial counselor, the AFC certification. I hope to be testing for that probably by the end of March. So fingers crossed for me. Okay, so quick poll. What's your current TSP contribution rate? So is it 0? Are you not even contributing? Do you not even know what's in your TSP right now, the amount? B, 1 to 4%, which you're missing the full match. 5%, you're getting the match. 6 to 10%, or are you maxing it out, 11+%? So that is my question to you. Quick disclaimer, this presentation is for educational purposes only and does not constitute financial investment or legal advice. Individual circumstances vary significantly, and you should consult qualified professionals before making any financial decisions. All investment Examples involve risk, including potential loss of principal. VA benefit amounts and eligibility are subject to change. They change constantly. Always verify current information at official government sources like the va.gov. The presenter is not acting as your financial advisor or planner, but I would like to be. And no advisor-client relationship is established through this presentation. Okay, so what is the TSP? Understanding your government retirement plan. So you have your employer retirement plans like 401ks. The TSP is a government-sponsored plan. Okay. So here are some thrift savings plan basics. The Thrift Savings Plan, or TSP as it's commonly known, is one of the largest retirement funds in the world. Not sure if you knew that. As of 2026 or 2025, it manages over $1 trillion in assets for more than 7 million federal employees. That includes all active duty, Guard, and Reserve members. If you're under the Blended Retirement System, or BRS, the TSP is a core part of your retirement. And even if you're not, you can still contribute to it. So here's basically what makes the TSP so special. First, it's government sponsored. It was created by Congress in 1986. And second, it's similar to a 401k. So you can make pre-tax contributions, which would be the traditional TSP, or after-tax contributions, which would be the Roth TSP. And we'll get into the difference in a different slide. Third, it's low cost. So TSP expense ratios can be as low as 0.036%, which is among the lowest of any retirement account in the world. The average mutual fund is between 0.5 to 1%. So you're saving thousands of dollars over your lifetime in expense fees. Fourth, it is tax advantage. So your money grows tax deferred in a traditional TSP and tax free in Roth TSP. For 2026, the contribution limit is $24,500 per year. There are catch-up contributions if you're 50 or older, and that's $8,000. So if you're 50 or older, you can possibly contribute up to $32,500 in total in a year. So the TSP, basically, it's powerful, low-cost retirement tool, and it's available for military members.
Hey, Sarah, can I add something right here?
Uh-huh.
Because I was doing some studying earlier today, and I also wanted to mention if the employee, the participant is 60 or over, the catch up is $11,250. So it's even more. And I think that's something that a lot of people don't think about if they've maybe been late starting making their contributions, but they're over 50, and especially if they're over 60, they certainly can put more money away.
Yes, thank you so much, Melissa. Yes, I think what I saw was it's like a super catch-up
Yeah.
contribution limit.
Yeah.
So yes, you get even more, you can contribute even more for
Mhm.
people who are starting late. Yeah. Which is great.
Yeah.
Okay. So here is a kind of side-by-side for the traditional versus the Roth TSP. And basically, you can, for the traditional TSP, your contributions are pre-tax, meaning they reduce your taxable income now. So if you make 60,000 and contribute 10,000 to a traditional TSP, you're only paying taxes on the 50,000 that year. Your money grows tax deferred, so no taxes on the gains each year. When you withdraw in retirement, you do pay ordinary income tax on everything, the principal and the gains. So The traditional TSP is best for people who expect to be in a lower tax bracket in retirement. I do have a little spot on there for the military bonus. So if you contribute from a combat zone pay, those contributions are tax exempt going in, and principal when the principal comes out, it's tax free.
Mm,
But we're going to go into combat zone pay advantage in a different slide. One of the downsides to a traditional TSP is that there are required minimum distributions called RMDs, and you have to start that at age 73. For the Roth side, your contributions are after tax. So you don't get an immediate tax break. You pay taxes on your income now, and then you contribute. Your money grows tax free, no taxes on the gains. When you withdraw in retirement, as long as it's been 5 years and you're over 59 and a half, it's 100% tax free, principal and earnings. So this is the Roth TSP is best for people who expect to be in a higher tax bracket in retirement or who want tax-free income later in life. Again, the military bonus on the Roth side, your Roth TSP contributions are tax exempt going in and tax-free coming out. But again, we'll talk about that in a different slide. The big benefit, of course, to the Roth TSP is that there's no RMDs. So you're not forced to take any money out if you're not ready. So it's flexible. Okay.
yeah. I also wanted to mention, RMDs is one of those things that come up all the time where people don't really understand. They don't really understand what they are. And of course, most people are going to start taking money out of their retirement prior to 73. But there is a group of people that don't need the money. And so what happens is by the time they turn 73, they are forced to take some money out. And people are always like, well, why? Why am I being forced to take money out if I don't need it? The reason why, if you think about it, that money has never been taxed, right?
Mhm.
It wasn't taxed when people made their contributions. The earnings from year to year were not taxed, and the government wants their tax base. So there's a calculation. Won't I'm sure we're not going into the calculation. For the most part, whatever the balance of that account is, let's say it's somewhere around 4%. By the age 73, they're going to require that you take that money out so that they can get the taxes on it. And if you don't, there's a penalty. So
Mm. Yeah.
I just wanted to kind of mention that. So on the Roth side, the fact that you never have to do that, if you don't need the money can continue to grow. So it's a big benefit.
Yes. Thank you for adding that. Yes. RMDs, I feel like we need to do a different webinar on that.
Yeah, certainly.
Okay. So, TSP funds, we're going to go into the different types of investment funds that are available through the TSP. Okay. So, basically, for the TSP, there are 5 core funds. You have the G fund, which is government securities. This is US Treasury securities guaranteed by the federal government. It's your lowest risk. Um, it earns a unique rate that typically outpaces money market funds, but don't expect big returns. Okay. This is best for capital preservation, near retirement investors, or people who have a low risk tolerance. You have your F fund, which is fixed income bonds. It tracks the US bond market, government, corporate, mortgage backed securities. It's low to moderate risk. Bonds are generally stable, but there is some inflation risk. Conservative diversification and reducing portfolio volatility. Okay, the C fund is common stock index. This tracks the S&P, and the S&P basically is made up of the 500 of the largest U.S. companies. It's moderate to high risk, but historically one of the strongest performing funds in the TSP. This is best for long-term growth. So our younger military members, our younger investors, with a long time horizon. The S Fund, small cap stock index, this tracks smaller US companies that are not in the S&P 500. This is higher risk, but there is higher growth potential. So this is best for aggressive growth, the aggressive growth portion of a diverse portfolio. And then you have your iFund. This is International Stock Index. This tracks developed international markets like Europe, Asia, Australia. It's moderate to high risk, but it does add geographic diversification to your portfolio. So this is best for global exposure and balancing your US stock holdings. Most people don't just pick one fund. You can split your contributions across all the funds to diversify, which is always a good thing. Or if you don't want to manage it yourself, there are other options, which are the Lifecycle Funds, which we'll go into in the next slide. Did you have anything on this, Melissa?
I don't. Well, no, I guess I do. What I have often seen with a lot of people that are in the TSP, especially people that have worked for the government for a very long time, they kind of do a set it and forget it, right?
Yeah.
And especially if they're conservative, yes, I've seen a lot of people have too much money in the government, in the G fund or the F fund, and yes, it's conservative. There's not a lot of volatility, especially in the G fund. You're just talking about guarantees. There's guarantees, but very, very low return. And when you think about over time, they're basically losing purchasing power, right? Because
Yeah.
inflation, the
Yeah.
cost of goods and services is going up. And so, even if people kind of start there, but maybe a little bit over time to get more comfortable, start moving things into the C fund, into the
Mhm.
S fund, into the I fund, until their comfort level gets a little bit better. But I literally have a client that has worked for the VA hospital, I would dare say over 30 years now. She has a sizable TSP balance,
Mm.
but she had it in the G and F fund for most of the time that she was working there. I
Oh,
encouraged her about 2 years ago, please move, a certain percentage of it into the C fund, and she is very, very happy today.
yay.
She's wishing, oh my gosh, if I had done this 30 years ago. So it is important to have a blend of these things, right?
Mhm.
And like you said, as people get closer and closer to retirement, to start scaling it back to become more conservative then.
Right. Yes. Okay, thank you. All right. So the life cycle funds, which is also available via the TSP. Now, these are you can compare these to like the target date funds and regular employer sponsored investment, um, I guess 401ks and IRAs, but life cycle funds or the L funds are a set it but don't forget it option. So here's how they work. Each L fund holds a mix of the G, F, C, S, and I funds. Okay, so they're just a mix of all of them. And the mix automatically shifts over time. So it starts off aggressive when you're young, just joining the military, just getting started, and it becomes more conservative as you approach retirement. So you'll see funds like the L income. Now this is it's the most conservative. It's for people who've already retired and they've decided they want to keep their money in the TSP. The L 2025 are for people who are retiring soon or have retired because it's from 2020 to 2027. The L 2030, the L 2040, and the L 2050, and now there's 2060 and 2070. So the further out the date, the more aggressive the mix because you have that long time horizon. The target date is based on when you plan to retire, not your birth year. So even if you're 25, you could choose the L 2060 if you plan to retire around 2060. So who should use the L funds? People who want a hands-off, diverse approach. New investors who don't want to manage allocations, anyone too busy to rebalance their portfolio. And just an important note, the fund automatically rebalances for you. So you don't have to do anything. It shifts from stocks to bonds over time without you lifting a finger. So if you're not sure where to start, an L fund matched to your retirement timeline is a solid choice. So
I agree. I would actually rather someone do the lifestyle fund than just stick it all in the G and F fund and never look
right,
at it. Yeah,
right, like you said, because then it loses it. It's not outpacing inflation. So yeah. Okay, so next we're going into the TSP versus other investment accounts like an IRA, Roth, brokerage, and more. Okay, I know this looks like a lot. Okay, so let's put the TSP side by side with other retirement accounts. So the TSP, traditional TSP Roth, they both have the same 24,500 limit for 2026 as far as contributions. The TSP traditional is pre-tax. BRS gives you up to 5% match. You do have limited investment choices. As you can see, we already went over the investment choices you have in the TSP. Um, you have penalty-free withdrawals at 59 or 55 if you separate that year. Um, the TSP Roth is like I said, the same 24,500 contribution limit. Now this is a shared limit, so you can't put 24,500 in the traditional and then contribute 24,500 to the Roth. It's shared. So just remember that. This is with after-tax contributions. You still get the BRS match up to 5%. You're still limited to the fund options that we talked about earlier, but withdrawals are tax-free if qualified. Okay.
Sarah, tell me again what BRS stands for our viewers.
Blended retirement system.
Hmm.
And there is a slide on that,
Okay.
so we'll go more into what that is.
Okay.
The traditional IRA and the Roth IRA for 2026 do have the same limit. It's you can contribute up to 7,500. And for the traditional, it's kind of the same thing, maybe pre-tax depending on income. There's no employer match, almost unlimited investment choices, and your penalty-free withdrawals at 59 and a half. With the Roth, same thing almost, except that you can access your contributions, not the earnings, the contributions anytime penalty free. With a brokerage account, you have unlimited contributions. There's no limit on how much you can contribute to a brokerage account. However, there is no tax advantage, no employer match. There are no withdrawal restrictions, but you do pay capital gain taxes on earnings every year. Now, the health savings account. The contribution limits for that for singles is 4,400 for 2026 and 8,750 for a family health savings account. The health savings account is unique. It's a triple tax advantage. Contributions are tax deductible, growth is tax free, and withdrawals for qualified medical expenses are tax free. If you are 65 or older, you can use it for anything. So you don't have to use it for medical expenses after when you turn 65. So the key takeaway is the TSP is powerful for the match and the low fees, but it's not your only tool. Okay, a smart strategy often combines the TSP with these other investment accounts. Anything you want to add? I know that was a lot.
It was a lot, but it's good information. I just wanted to mention under brokerage, some people do have a brokerage IRA.
Mhm.
And so it would fall under the same rules as the traditional IRA in terms of the limits and everything else.
Okay.
What you're talking about here is a non-qualified or a non-retirement brokerage account. So I just want to make sure people were clear. That is the account where you can put an unlimited amount of money in there. And of course, it's taxable and all those kinds of things. So good
Mm.
job for lots of information.
Yes. Thank you for that. Okay. So this is the Roth IRA, and it's is how it's the TSP's perfect partner. Okay. It's a power combo. On your left, you have the TSP. You have employer match, low fees, high contribution limit. But the downside is there's limited fund choices and required minimum distributions if you're in the traditional TSP. On the right, you have the Roth IRA. Tax-free withdrawals, no RMDs ever, and wide investment choice. You can invest in individual stocks, ETFs, whatever you want, but the limit is that 7,500 per year, at least for 2026. And there are income limits for the Roth IRA. So basically, here's the strategy. Step one, you contribute at least 5% to your TSP to capture the full BRS match because that's free money. Step two, you open a Roth IRA. You contribute up to the 7,500 per year. Step three, if you can afford it, max both accounts. The TSP gives you the match and low fees, and the Roth IRA gives you flexibility and tax-free growth forever. Step four, you use your TSP for stable, low-cost core holdings, and you use your Roth IRA for growth assets you want tax-free. So important note, like I said, there are income limits for the Roth IRA. And so that's just something to be aware of. And for the 2020 and for 2026, those limits are listed right here. So 153 to 168 if you're single, 242,000 and 252,000 if you're married. At those levels, considering a backdoor Roth IRA strategy, we're not going to go into that. That's a little high level. But if you're interested in learning about the backdoor Roth IRA strategy, I know we could probably do that webinar for you guys because
Some,
you have experience in doing that, right?
yes, yes. Or sometimes they're called Roth conversions. What I wanted to say though, even though that is beyond the scope of what we're talking about today, and I think we should do a webinar on that later. When people start thinking about these phase outs, what we're talking about when people do their taxes, their adjusted gross income, which for
Mhm.
most people is that 1040. It's usually the bottom line on the first page of the 1040. That's usually where it is. If it falls in this range, where basically the government is saying that you cannot contribute the full amount or maybe any amount into your Roth, that would be a reason to go back to the TSP Roth version, right?
Mhm.
Because that would be even easier. If someone really wants to fund a Roth IRA and they're limited to the 7,500, but think about how much more they could put in the TSP. In fact, they could put the 5% in the TSP, get the 5% match, and then their next dollar put it in the TSP Roth,
Yeah.
which is the same power combo that you're talking about, but you didn't have to go out and start another Roth IRA, and you're also not limited to the phase out. So that's something that people really should consider as well.
Yes. For military members, I don't know the military pay tables for this year.
Okay.
I just know when I was in, we were not anywhere close to these numbers. So because I feel like that's a stigma. People think that military members make a lot of money, and it's like we really don't.
Mhm.
But we do have is a lot of benefits.
Yes.
That's what we do have.
Yes.
So Okay. All right. So we're going to talk about the blended retirement system. So the blended retirement system is kind of a new thing. It came out if you joined the military on or after January 1st, 2018, you're automatically under the blended retirement system, the BRS. If you joined before then, you could opt in, which is great. And then if you're still under the legacy system, some of this won't apply, but it's still good to understand because you can opt in to it. So the BRS has three pillars. It has the defined benefit, which is the monthly pension. So you serve 20 years and you earn a pension of 2% times your years of service times your highest 36 months of base pay. So 20 years basically equals 40% of your base pay for life. That's the defined benefit. This is reduced from the legacy system, which was 2.5%, but you do get the other pillars to make up for it. So pillar number 2 is the defined contribution part of the BRS. That's the TSP matching. So DoD automatically contributes 1% of your base pay to your TSP after 60 days of service, even if you contribute nothing. If you contribute, DoD matches up to 5%. So maximum DoD contribution is 5% of your base pay. So that is free money. If you're not contributing at least 5%, then you're leaving money on the table. And then the third pillar is the continuation pay mid-career bonus. I did not receive this because it's new. I got out in April 2016, so I did not get this third pillar, but I think it's great. It is a one-time lump sum paid between 8 to 12 years of service. Minimum, it's 2.5 times your base pay. You must serve 3 to 4 more years to receive it. So I feel like it's like kind of that bonus to, hey, stay on, stay enlisted.
It's a golden handcuff.
Yeah, basically. So for the mid-career bonus, don't just spend it, invest it strategically. Max out your Roth IRA, increase your TSP contributions, or build your brokerage account. Important, if you joined on or after January 2018, you're automatically in the BRS. If you joined before and didn't opt in, you're under the legacy. If you're unsure, if you don't know, check your MyPay account or talk to your personnel office and they'll be able to help you. But yeah, I didn't get to be a part of this blended retirement system, the BRS, but I think it's pretty cool.
I wanted to ask this question for those that are watching that are not in the military. I'm assuming DOD is Department of Defense.
Department of Defense, yes. Thank you catching me on all the military acronyms.
Well, I know that sometimes people that are not in the military are also watching. And so I still think it's good information. They may have a spouse or son or daughter that are in the military. And I think it's still good for them to understand how their benefits work.
Definitely. Yes. Okay, here are some military money advantages that I wanted to go over. So beyond the BRS, military members have financial advantages most civilians will never have access to. So, just make sure you're using them. I covered some of these in a different webinar, but I thought it would make sense to add them here. So your combat zone tax exclusion, pay earned in a combat zone, which unfortunately, as the time of this recording, there's some things going on that some more military members might be in a combat zone. So your pay in a combat zone can be excluded from federal income tax. TSP contributions made from combat zone pay are tax exempt, even on withdrawal from a traditional TSP, and that is huge. Special and incentive pay, so like your flight pay, your hazardous duty pay, sea pay, all of this can be contributed to the TSP. So maximize TSP contributions during high pay periods to supercharge long-term growth. Your VA home loan plus your housing strategy. Your VA home loan benefit, which is no down payment, no PMI, private mortgage insurance, frees up capital for investing. Military women who leverage VA loans often have more disposable income to direct into the TSP, Roth IRA, or other brokerage accounts. You have TRICARE and the health savings account strategy, which is while you're on active duty, you have TRICARE. And after you separate, you may become HSA eligible, which, as we covered earlier, a health savings account, HSA, offers a triple tax benefit on contributions, growth, and qualified withdrawals are all tax-free.
Sarah, tell our viewers that are not in the military what TRICARE is.
TRICARE is basically the health plan that you're on, the healthcare plan. So equivalent to like United Healthcare, Blue Cross Blue Shield, Anthem. You military members, well, active duty have TRICARE.
Okay.
And it is a really, really good healthcare plan. One of the best, actually. And like I said, we might not get paid a lot, but we have other benefits, and TRICARE for me is one of those benefits I feel like, kind of makes up for not getting paid as much.
So if a military person is not on active duty, they have some other form of health care, but when they're in active duty, they have this higher level of health benefits, right? Which would make sense because they're more likely to be injured, more likely to be susceptible to chemical warfare, all kinds of things, right? Emotional things. So that I just want to make sure I'm clear. The military has healthcare, and then when they're active duty, they have TRICARE. Is that correct?
When they're on active duty, they do have access to. There's basically a military hospital almost on every base.
Yeah.
And they have access to that. If they, for some reason, have to go out for something, or say they're on vacation and they have to go to the ER, that's when they use their TRICARE.
Okay. Got it. Okay. Thank you for that.
Yeah. Yeah, no, of course. Yeah. Let's see. This SBP, which is the Survivor Benefit Plan for surviving spouses. This is another military money advantage. It provides income continuation for military spouses if the military member passes away. And like I said, I'm a surviving spouse myself. So I've dealt with this for over 10 years now. But understanding how it works with DIC, now I can't remember what DIC stands for. It's always a hard one.
Okay, I was going to say, I was like, well, what's DIC?
Yeah, I'll have to come back to that. It's another form of payment that surviving spouses get. But knowing how it interacts with that and your VA benefits is critical if you're a surviving spouse or planning your own SPP election. So the military member will elect their survivor benefit plan. It has to be elected. It is not an automatic benefit. You have to, work with your personnel office and get it started.
You want me to tell you what DIC stands for?
Yes.
Dependency and Indemnity Compensation.
I knew indemnity was in there. Thank you.
have a lot of acronyms that we have to remember. So
So many acronyms
yes,
in the military and in the finance world.
yes.
Last but not least is the GI Bill benefits. So your education benefits have financial planning implications. Your Chapter 35 benefits for dependents of disabled veterans may impact how you sequence educational versus retirement savings. So these are tools you've earned. So I encourage you to use them and understand them.
I would agree. My father never used his VA benefits,
Mm.
well, his GI Bill benefits, more specifically the VA home loan.
Yeah.
My father never used it, and so when he passed away, that passed away with him. And
Oh,
even though we had talked about it, we talked about, maybe purchasing something together, um, using his VA loan, and I wish we had done that because that could have been a nice rental property for me now.
definitely.
Or I
Yes.
could live in that house, and the one I'm in now could be my rental property.
Yes. It's that one's a big one. I mean, you can definitely build a whole real estate investing portfolio with your VA home loan for sure.
Absolutely, and especially not having to pay PMI. So very often when we're talking with clients that are wanting to purchase a house, I mean, ideally, they should put 20% down so they don't have to pay private mortgage insurance. And I think one of the things that most people don't realize is that when people have to pay private mortgage insurance, it does not protect them. It protects the mortgage lender.
Yeah.
You are paying the insurance premium for somebody else.
Yes.
So that is a huge benefit, and not having to put 20% down to avoid it.
Yes. No, these are huge. That's a huge one for sure.
All right.
Okay. Okay, so here's the combat zone tax advantage. I was said that we were going to talk about. So this is probably the most powerful and the most overlooked benefit available to military members. If you've been deployed or you're about to deploy, uh, which, like I said, there's some things going on as of this recording that people might be getting deployed soon. Here's the setup. So you're deployed and you earn $10,000 in combat zone pay. That pay is already tax exempt. You don't pay federal income tax on it. But what happens when you contribute that money to your TSP? So on the left-hand side, you have the traditional TSP. On the right, you have the Roth. So for the traditional, you take that $10,000 in combat zone pay and you contribute it to your traditional TSP. Your first 10,000 goes in tax exempt. Okay. Then you contributed $10,000 to traditional TSP. The contribution itself is tax exempt. Now that's the combat zone benefit. No taxes on the way in. When you retire and withdraw your principal, that original $10,000 comes out tax free. And this is unique to combat zone contributions. Normally, traditional TSP is 100% taxable on withdrawal, but combat zone contributions get special treatment. But here's the catch, okay? Any growth, which it grows to 76,000 over 30 years, you do pay taxes on the 66,000 in gains, okay? Now, your principal is tax-free, but your earnings get taxed. So, but for the Roth TSP, this is where the magic happens. Same scenario. You put in the $10,000 in your combat pay. You contribute it. It is also tax exempt going in over 30 years. An average of 7% annual return grows to 76,000. When you retire and withdraw, you withdraw everything. It's 100% tax free, the principal and the growth. So zero taxes on the contribution, on the growth, on the withdrawal. Okay. Why Roth TSP wins for the combat zone contributions? It's because normally when you contribute to a Roth account, whether it's Roth TSP or Roth IRA, you pay taxes on your income first, then you contribute. That's the trade-off. You're paying taxes now, get growth-free, tax-free growth later. But with the combat zone Roth TSP contributions, you bypass the first step entirely. Your combat zone pay is already tax exempt, so you're not paying taxes going in, but you still get the Roth benefit of tax-free growth and tax-free withdrawals. So that's called double dipping. But it's 100% legal. In
Yeah.
fact, it's by design. Congress created this to reward service members deploying to combat zones. And personally, I think they deserve it. They're going into a combat zone. They're putting their lives at risk. So let them keep all their money. That's how I feel.
Sarah, let me ask you a question about combat pay. Is the combat pay over and above what the military person is already receiving?
Yes. So when I deployed to Afghanistan, I got my military pay, my normal E5 pay, which is E5 is a rank.
Hmm.
It goes from E1 all the way to E9. That's for enlisted. The E stands for enlisted. So I got my pay, and then I got my combat zone pay.
Hmm.
So it's definitely it's on top of your military pay that you
Okay.
already get.
So for someone that's in the military now that is going to deploy, they can choose where that combat pay is going to go, and they absolutely should choose the Roth TSP.
I believe so. I think so. I mean, it's got the most tax advantage.
Yeah. Plus, Roth, there's no RMDs.
Exactly.
So
So
on
it's
the
flexible.
traditional TSP, not only I still got I contributed tax exempt. I could pull that 10,000 out tax free, but that other 76,000, I got to pay tax on it. And if I haven't taken it out by age 73, now the government is forcing me to pull money out, and it's probably a larger number, and I have to pay tax on it.
Yeah,
Okay. This is really good information for anybody that's in the military to know right now.
exactly. Like I said, because current as of this recording, there are
Yes.
some things going on that
Right.
people are about to be in some combat zones.
Yeah.
Um, but yeah, no, it's great information. So I definitely wanted to make sure we covered that.
Okay.
Okay, so building your strategy, action steps for your future. All right. So here's kind of an investment strategy by kind of your life stage where you're at in your career. Um, Early career, so you can join the military at 18. I think you can even join it at 17. I think I had somebody that I served with that joined at 17. They just had to get a waiver.
Hmm.
But either way, this is early career. So you're shooting for maximum growth. Okay, so contribute at least 5% to capture the BRS match. Consider 100% C fund or an L 2060 or 2070 fund. Open a Roth IRA and max it out if possible. Build a 3 to 6 month emergency fund, which is, I think everyone should,
Hmm.
military or not, should be having an emergency fund.
Hmm.
And then if you're deployed, make sure you're maximizing your combat zone contributions. Okay, whether that's in the traditional or Roth, but as we saw on the last slide, the Roth TSP is going to be your best bet for combat zone pay. Mid-career, this is for growth and stability. Increase your TSP contributions as you rank up and as your pay goes up. Diversify across C, S, and I funds. Contribute Roth IRA. Continue your Roth IRA contributions. Really important, review your beneficiaries. By mid-career, you probably have family, started a family, you have dependents. So making sure your beneficiaries on all your accounts are accurate. Making sure you're looking into that annually. Consider your continuation pay investment strategy. Now, remember, the continuation pay was one of the tiers of the blended retirement system. So that's that bonus that you're going to get between 8 and 12 years of your service time. Making sure you have a good strategy for that bonus. Pre-separation, you're looking at preservation and your transition. Do not withdraw TSP at separation. Keep it or roll it over into an IRA. Consider rolling TSP to an IRA for more investment choices. Understand your bridge strategy. This is TSP withdrawals before 59. There is a rule of 55, so you can access it if you're 55 or over. And
Is that a 72T?
I'm sorry?
Is that a 72T distribution, or is it something specific just to the military?
It's something specific to the military. Yeah. Review your SPB election if you're retiring with a pension. And then account for how your VA disability rating will impact your income. And then post-separation, age 55 and over, you are focused on income generation. So the rule of 55, if you separate at 55 or older, you can access your TSP money penalty-free. Coordinate your TSP, pension, VA disability, and Social Security. So you got a lot to juggle, more than, the average citizen. RMDs begin at 73 if you were in the traditional TSP. Consider Roth conversions to reduce your future RMDs, and work with a fiduciary advisor or planner on your withdrawal sequence, or, if you have any questions on any of this. So
I think that this is really, really good, Sarah. And also I wanted to mention another benefit. I was asking about 72T. So for people that are not in the military, there is a way for people to withdraw money out of their qualified money, their 401ks and IRAs prior to 59 and a half without having a penalty. But it's called 72T. And what 72T is, says you can start taking your money out as early as 55, but you have to take out equal and substantial distributions.
Okay.
What usually happens is they have to take out more money than they actually need. And that money that you're taking it out and paying tax. You're not paying the penalty, but you're still paying the tax. Well, once you've taken it out more than you need, that money that's not still in the account is not growing.
Yeah.
So for a military person that can do this, hugely beneficial. And also, where you say here, consider Roth conversions to reduce your RMDs. The fact that now the military, the TSP, has the Roth option in it, people can actually stuff even more money into the Roth through their 401k contribution, as opposed to having to go outside and do a contributory Roth IRA. And the reason why I'm also thinking about this is as people move through their military career and they rank up, like you say, you talked about you were E5 and you're E6, E7, 8, E9, making more money, and then maybe also married, they might not be able to contribute to an outside Roth because of the phase out, right? So, but there's all these different things that they have available to them, which I think is hugely beneficial.
I agree. Yeah. And the 55 rule, I feel like is beneficial and necessary, because you have people coming in. A lot of people I know, they came in at 18, they do their 20 years, and then they get out and do another career for 20 years.
Yeah.
So all before they're 55. So it's important for that 55 rule, I think.
Yeah. And the very last one that you talked about, working with a fiduciary advisor and on withdrawal sequencing, whether someone's in the military or not, withdrawal sequencing is really important. People understanding there is an optimal, what's the word I'm looking for? I don't want to use the word sequence, but an optimal order of how you start spending down your assets.
Right.
Of course, for most people, they're thinking about, okay, I've got 401k. Maybe I have that outside brokerage account. Maybe I have Social Security. Most people don't have pensions. Military people do. What money should I start spending down first?
Mm-hmm.
And if it's done correctly, that money can last longer and maybe be more money that they have to spend during retirement versus if they just, I'm just going to take this one out first and not really give it any thought. They could be running out of money more quickly, which can really be an issue if they live long, if they live long but not as healthy.
Right. Yeah. And we work with withdrawal orders all the
All
time when we
the
do
time.
financial plans. Yeah.
All the time.
Mhm. Okay. All right. So this slide is the power of starting now. So time is your biggest asset. And so we're assuming here a 7% average annual return. So starting at 22, you contribute $200 a month for 38 years. You'll have 452,000 at retirement. You contributed 91,200. The rest is growth. And then look at the drop from starting at 22 versus starting at 30.
Mhm.
So you're just contributing, you start contributing at 30, same amount for 30 years, and you'll have 243,000. Okay. And then 40, you have 104,000. At 50, you'll have 34,700. So that starting at 22 versus 30, you get 209,000 more with the same $200 a month contribution. And then it, giving the same average annual return.
Mhm.
So every month you delay costs you more than a month of contributions. So start today, even if it's a small amount, $50 a month. Um, start with what you have. It's important. Time is like I said, is your biggest asset
Absolutely.
when it comes to investing.
I have nothing to say on that one.
Okay.
It's perfect.
All right, 7 costly mistakes to avoid. Cashing out, like I said, your TSP at separation. If you're, younger than 59 and a half, you have a 10% penalty plus income tax. And then your loss of all your future tax deferred growth. So, roll it over into an IRA instead. Mistake number 2, not capturing the full match. You're leaving money on the table. Mistake number 3, leaving everything in the G fund. Like you said, Melissa, your friend did. Yeah. It's safe, but often doesn't keep pace with inflation long term. Mistake number 4, ignoring your beneficiary designations. So just making sure that your money is going to where you want it to go. So make sure you're reviewing that annually. Especially after big life events like marriage, you have a kid, stuff like that, divorce. Mistake number 5, taking TSP loans. You lose the growth that the money would have earned, but also loan repayments are made with after-tax dollars. But if you are taking a loan from a traditional TSP, it's taxed again on the withdrawal, so you're getting double taxed. Mistake number 6, not planning for survivor benefits. Like I said before, you have to elect this. And the VA, the military, it's not going to just automatically enroll you into this. You have to elect it. And then number 7, waiting for the perfect moment. Like we said, time in the market beats timing the market. And I think we've said that before in on other webinars.
I wanted to add something to number 4, ignoring the beneficiary designations. This is something that comes up with us all the time.
Mm-hmm.
Um, with we already know the statistics around divorce. About 50% of all marriages will end in divorce.
Mhm.
And then a lot of people will remarry. And so when people do not check their beneficiary designations, and a lot of people mistakenly think that whoever I list in my will is going to get the money, but beneficiary designations bypasses probate. And what that means is whoever you listed on there, because that's a contract, that's who's going to get the money. So if you left your previous spouse and then you remarried and then you redid your will and you said everything's going to my spouse, but you didn't go back and change that beneficiary designation, whether it's on your life insurance policy, whether it's on your 401k, anything that is contractual, whoever you listed, that's who's going to get it.
Yep.
And so that's why we're always telling people. And I saw this statistic about a week ago. The average person does not check their beneficiary designation for 19 years.
Oh my goodness. That's
Yeah,
crazy.
19 years. Where people should really check them every year. Just like you go to the doctor and you get your annual checkup, you should check your beneficiaries every single year.
Yeah. It's part of your overall financial planning checklist.
For financial health. That's correct.
Yes. Mhm. Thank you, Melissa.
You're welcome.
Okay. Your 90-day action plan. So, let's go ahead, and this is just kind of something to consider. So day 1 through day 30, laying that foundation. So make sure you log into MyPay and check your current TSP contribution percentage. Confirm that you're contributing at least 5% to get the match. You can review your TSP fund allocation. So what fund are you in? Verify your TSP beneficiary is correct and current. And then see if you're in a traditional Roth TSP. So that's your first 30 days. Day 31 through 60 is optimizing. You're evaluating switching to a Roth TSP, opening a Roth IRA if you don't have one, access your fund allocation or assess your fund allocation versus your timeline to retirement, and you review your VA benefits status and any unclaimed benefits, and calculate how much you'd have at retirement at your current contribution rate. There are calculators, and it'll be in the next slide, some tools and resources. There are calculators on tsp.gov that you can use to do that calculation. Day 61 to 90, increase your TSP contributions by 1 to 2%. You likely won't feel it, especially if you're getting pay raises instead of, increasing your lifestyle expenses. You know, Reward your future self and contribute to your retirement. Set up automatic monthly contributions. Schedule a free consultation, with a fiduciary advisor planner, such as myself and Melissa. And we can create a written financial plan with your goals and your specific timelines. And I would definitely, stress to share this knowledge with another military woman, military person in your circle. I think that's the biggest way us veterans and military people learn is from each other. And so definitely once this is uploaded onto our YouTube channel, sharing it with as many people as you can.
Probably the only thing I would add here, Sarah, because we've talked about, whether someone contributes to their Roth inside their TSP or versus outside.
Mm-hmm.
If they're in the TSP, it's going to be the same 5 core funds or a lifestyle fund.
Right.
If they have their Roth IRA outside,
Mm-hmm.
they're going to have a lot more options and very different options, right? So there could be some benefit in that as well. So either one, we're not saying one is right or wrong. We're just saying that it's good to have some Roth.
Right. It can be a very powerful strategy.
Yes.
Yeah. Okay, here are the trusted resources I was telling you about. So for the TSP, you have the tsp.gov. Your My Pay, which is basically how military people go in and check their pay stubs and stuff like that. And then the TSP calculators are, where you can do those calculations as far as what your retirement income would look like. Military financial resources, you have MilConnect, where you can manage military pay records. FinRed, which is the DoD, Department of Defense's official financial literacy hub. I just recently found this out, or found this resource. It's great. I mean, anytime there is a resource for financial literacy, I am like all about it. I'm bookmarking all of it. Military One Source, you can get free financial counseling. For active duty, guard, and reserve. There are some free resources for military veterans as well. And for transition resources, you have Hiring Our Heroes, which I recently used for a resume review, and it is free. All this is free. They have free job fairs, career coaching. It's free. I can vouch for that. SkillBridge is the Department of Defense's internship program. So you can work with civilian employers during your last 180 days of service while you're still getting your military pay. So that is a unique program available. And then the VA e-benefits portal, this is basically where I live all the time. See what my VA benefits are going to be, file your claim for disability, update dependents information. It's basically any type of benefit is at the e-benefits portal. And then, of course, if you want personalized guidance, you can contact us at Investor Fiduciary Solutions. And I try to help all women, military women across all branches. Okay. We are almost done, Melissa. All right, key takeaways. So takeaway number 1, get the match. It's free money. Roth TSP for most military members. In your combat zone, pay equals a Roth GOLDMINE. So combat zone Roth TSP contributions are tax exempt going in and tax free with growth coming out. Takeaway number 4, TSP plus Roth IRAs, a power combo. Number 5, don't cash out at separation, roll it over or keep it in there. And then number 6, of course, your time is your biggest asset. So start today, even if it's a small amount.
I concur.
All right, next steps. So connect with me. I would love to help you out in any way I can. Think of me as your financial planning partner and just fellow veteran that you can talk to. We both offer free 30-minute strategy sessions. That's where you can book at the IFS Military Money. You can book me. You can email me. You can call my office number. And, of course, check us out on our website, LinkedIn. You can see all my information as far as my history. But yeah, I'd love to connect with you. No question is too small.
I just want to say, for anyone that's thinking about contacting Investor Fiduciary Solutions, if they're a veteran, I really think they should reach out to you, Sarah. I have worked with veterans, but I myself am not a veteran. So while I may be aware of all these resources and places to go for additional information, you are living it.
Yeah.
You are logging into My Pay on a regular basis. You're logging into these resources where I am not. And so I would highly encourage anyone with a military background or currently enlisted to reach out to you for more information and for some support.
Thank you, Melissa. That means a lot. All right. Okay. Thank you all so much. And thank you for your service. If you're a veteran or a military member watching, you can follow us on LinkedIn, Facebook, Instagram, and our YouTube channel. So thank you again. And I hope it's Saturday. I hope you enjoy the rest of your weekend.
Thank you, everyone, and great job, Sarah.
Thank you, Melissa. Bye, y'all.
Bye.